Okay, good afternoon, ladies and gentlemen, and it's really great to be at the first Cogence Summit. Let me just begin by thanking everyone from Discovery and from BlackRock that have really made today so far a fantastic event. Let me get going and try kind of sum up a lot of the key themes that have been mentioned this morning and really concentrate on retirement planning for your clients. Of course, we know it's been an incredibly complex and volatile environment. There's increased longevity. We know clients are living longer as medical technology continues to improve, and retirees are outliving their savings by more than a decade. If you think of the average life expectancy of a Vitality client being around 83, if a client in fact was sicker in those earlier years in retirement, they will typically have 3 times more out-of-pocket medical expenses. That will impact their retirement fund. On the other hand, if a client had to live 5 years longer than the expected, than the life expectancy, that will further reduce their replacement ratio, typically below 50%. So it's quite a complex advice spectrum that you have to think about for your clients. Of course, if you're able to actually optimize all of this and shift that curve up, make sure you've got the right assets and that the money lasts for a healthy retirement, you've really achieved the gold standard. On the left-hand side, we're trying to work out how do we maximize the retirement income sufficiency for your client. And really it's built up of 2 sections. Number 1, the accumulation phase, building up that fund prior to age 65 in a typical retirement age. And then, of course, in retirement, the drawdowns. What do you draw down and make sure that that fund will last for the life expectancy of the client? So let me delve a little bit into savings behavior. And of course,
the conference has highlighted the province's growing appeal as a hub for investment and economic development. As KwaZulu-Natal continues to take advantage of its strategic advantages, the conference has highlighted how important or the vital role that the province plays in South Africa's economic future.
Actually that they were making very rational choices. But of course, as Grant has just spent a lot of time taking us through the fact that clients are actually largely irrational. So we believe very much in Discovery in all of our product houses that product design is absolutely key to facilitating behavior change. We know the science of loss aversion. Clients don't want to lose something that they have. So portfolio construction just looked a lot simpler a decade ago. So what has changed since then? Well, there's been a massive proliferation of funds. There's a huge amount. You guys see it every day, the number of unit trusts in the market. And of course, there's a perception that the lower the fee, the better the performance. But of course, that's totally incorrect. As the scatter graph shows you, you've got funds at different levels of fees, high fees, low fees, getting top performance, and on the other side, getting poor performance. And then clients are also irrational in looking at past performance to make decisions. If you look at the right-hand side, I've shown their funds that were in the first quartile from October 18 to September 21. If you look over the next 3 years to September 24, only 56% of them had above average performance. The other 44 were below average. So what you see now is that with Reg 28, of course, the picture is a lot more dispersed. The risk is higher because a lot more funds can go offshore, and the returns will be more variable over time. It's early days in Reg 28, but you can expect when you look at this in 5 years' time, it's going to look incredibly different. And I think that further just increases the complexity for you as advisors. That increased risk really manifests in a lot of conservatism. These are the CISA stats every year since 2009, and you can see where the money has gone in the South African market. The dark blue bars are really the income funds. So since 2017, people have put their money into income funds rather than into balanced funds, into equity funds, etc. The cost of getting this wrong is really significant. This slide just shows different asset allocations, and over the period that we benchmarked it, it depended what your asset allocation was. But you can see the income could have varied from only 15 years worth in retirement, up to 25 years in retirement. And therefore, we believe there's no substitute for scale, and hence the Cogence team were very insistent on having a collaboration with the company of the gravitas of BlackRock. They have a team that is taking a huge universe of funds, over 140,000 funds from many different asset managers, putting it through a BlackRock manager research engine, which distills that into a focus list, and then further reducing that to a defined list of funds, which is included in their solutions. Aladdin is incredibly important in our lives as well. As Leah mentioned, they take in excess of 3,000 granular risk factors into the technology. That's a massive amount of data that has to get processed across all the various asset classes to make the decisions, to get the risk factor decomposition, to provide the deep dive analytics, but also importantly to give you as an advisor stress tests for the future. What we have done is we've taken and worked with the Aladdin Wealth team to create a retail version of the technology for you. So you have this in your office. When you do a client proposal, it is done through the use of the Aladdin Wealth technology. And then let me move on to the last part, which is really understanding life expectancy of our clients. Now we know life expectancy is increasing across the globe. This kind of shows by continent what the expectation is by 2050. Of course, there won't be a day that goes by where any credible publication won't have an article on wellness, on improvements or innovation in the medical space. But of course, as financial advisors, very often when you do planning, and we often get the call, what should we use as like the life expectancy for a client? And we tend to think of an average. The average, which we see in Vitality, is 83. So people look at 83 and plan for that. But you should know, sitting in the audience, that 60% of your clients are going to have a life expectancy above 83. Right? So for every 100 clients you've got, 60 of them are probably not being thought of correctly in terms of how you're planning that they've got sufficient assets in retirement. And therefore, we think of the concepts for a client of their total lifespan, how many are healthy years and how many are sick years. And really the objective is to maximize the healthy years and of course minimize the sick years. If you look at the US market, it's so interesting to see that your client's health has become such an important part of their financial plan. This shows the percentage of median income that is being spent on healthcare. And you can see how that's just increasing every year. We also know from our Discovery Health database that the average claim of a sick client in retirement is considerable. It's in the order of 200,000 Rand compared to a healthy client, where the claim amounts are very small. So these factors have such a big impact on what you thought was the reasonable pot of assets for their retirement. And now, of course, who knows if that is actually going to do the job or not. It's very interesting that a survey was done. There were 55-year-olds were asked, well, there was a group of them that were healthy and a group of them that were sick. And every 2 years for 10 years, they were asked, how do you feel? In terms of the healthy clients, 1 in 10 spent more than 5 years being sick. In terms of the sick clients that were asked at age 55 and every 2 years thereafter, 7 in 10 spent more than 5 years being sick. In other words, the current health of your client today is a good predictor of where they're going. So really, how do you optimize for retirement? Number one, savings behavior. Okay, one needs to make sure that clients are investing the right amounts of money from the right age every year. They're topping it up. They're making sure that that pot of assets grows for retirement. Number two, it's getting the right return. That's our whole collaboration with BlackRock. We totally believe that through Cogence, you are able to get the solutions that deliver that for you. And thirdly, in terms of life expectancy, there are great tools through programs like Vitality where one can actually manage and help a client in terms of planning to have the healthiest possible retirement.